Welcome everyone. Today we're diving into a critical and often misunderstood topic, stock market compounding. We hear it all the time. Invest in the stock market, let your money compound, and you'll be wealthy in no time. But is that really the case? In this video, we'll explore how stock market compounding isn't quite the same as regular compounding, and why the widely sold idea of effortless wealth through the stock market might be misleading. By the end of this video, you'll have a clearer understanding of how stock market compounding works, its limitations, and how to navigate these waters more wisely. The basics of compounding. To start, let's break down the concept of compounding in its simplest form. Compounding occurs when the earnings on an investment generate their own earnings. This process can create exponential growth over time. For example, if you invest $1,000 at an annual interest rate of 5%, after 1 year, you'll have $1,050. In the second year, you earn 5%, not just on the original $1,000 but also on the $50 interest from the first year, resulting in $1,102.50. This is how compounding works in a regular, predictable environment like a savings account. The stock market compounding myth. When it comes to the stock market, the principle of compounding is often touted as a surefire way to grow wealth. Financial advisors and investment books frequently use historical average returns like 7% or 10% per year to illustrate how investments can grow over time. However, this portrayal of stock market compounding is overly simplistic and doesn't account for the complexities and risks involved. The reality of stock market returns. Volatility and fluctuations. The stock market is inherently volatile. Unlike the steady, predictable growth in a savings account, stock market returns fluctuate significantly from year to year. 1 year might see a return of 20%, while the next could witness a loss of 10%. This volatility means that the actual path of your investment's growth can be very different from the smooth curve depicted in many investment illustrations. Example: consider an initial investment of $1,000 in a volatile stock market. In the first year, the market grows by 20%, bringing the investment to $1,200. In the second year, however, the market declines by 20%, reducing the investment to $960. Despite an average annual return of 0% over the 2 years, the actual investment is worth less than the original $1,000. Sequence of returns risk. The sequence in which returns occur can significantly impact the final outcome of your investment. Positive and negative returns do not cancel each other out in a straightforward manner when compounding. Example: imagine two investors, both investing $100,000 over 20 years with an average return of 7% per year. Investor A experiences early positive returns and later negative returns, while investor B experiences the opposite. Despite having the same average return, their ending balances will differ significantly due to the timing of returns. Selling the illusion. Many financial advisors and investment firms use the concept of stock market compounding to attract investors. They present historical average returns and suggest that by staying invested over the long term, your money will inevitably grow. But this narrative overlooks several critical factors. First, historical averages versus actual returns. Historical averages are not guarantees. They smooth out extreme highs and lows and may not represent the range of experiences investors will face. Second, ignoring fees and taxes. Investment returns are often presented without accounting for fees, taxes, and other costs, which can significantly reduce net returns. Finally, overlooking individual circumstances. Personal financial goals, risk tolerance, and investment time horizon vary widely. The ideal strategy for one investor may not suit another. Understanding real compounding in stocks. Dividend reinvestment. One aspect of stock market compounding that works similarly to traditional compounding is dividend reinvestment. When dividends are paid out, reinvesting them to purchase more shares can contribute to growth. For For example, if you own 100 shares of a company paying a $1 annual dividend, you receive $100. Reinvesting these dividends to buy more shares increases your holdings, potentially boosting future dividend payments and capital gains. Capital gains. Compounding through capital gains occurs when the value of your investments increases, and you reinvest those gains. However, this form of compounding is subject to market fluctuations and is less predictable than dividend reinvestment. For instance, if a stock's price rises from $50 to $75, selling and reinvesting the gains in another promising stock can enhance your portfolio's growth. Yet, capital gains are not guaranteed and depend on market conditions. Practical steps for navigating stock market compounding. Diversification involves spreading investments across various assets to reduce risk. By not putting all your eggs in one basket, you can mitigate the impact of poor performance in any single investment. For example, a diversified portfolio might include stocks, bonds, real estate, and commodities. If one asset class underperforms, others may perform better, balancing the overall returns. While stock market compounding is more complex than regular compounding, a long-term perspective can help smooth out volatility. Staying invested through market ups and downs allows time for recovery from downturns. For instance, during the 2008 financial crisis, many investors saw significant losses. Those who remained invested and continued contributing to their portfolios generally recovered and benefited from the subsequent market rebound. Consistently adding to your investments can enhance compounding. Dollar cost averaging, where you invest a fixed amount regularly, can reduce the impact of market volatility by buying more shares when prices are low and fewer when prices are high. For example, investing $500 monthly in a diversified portfolio regardless of market conditions helps accumulate shares over time and leverages the benefits of compounding through regular contributions. Minimizing fees and taxes is crucial for maximizing returns. High fees and taxes can erode the compounding effect, so choosing low-cost investment options and tax-efficient strategies is essential. For instance, opting for index funds with low expense ratios and utilizing tax-advantaged accounts like IRAs and 401ks can reduce costs and enhance net returns. The psychological aspect of compounding myths. The belief in effortless wealth through stock market compounding can lead to overconfidence and herd mentality. Investors might follow trends or rely on past performance without critical analysis. For example, during the dot-com bubble, many investors poured money into technology stocks based on the assumption of perpetual growth. The bubble burst, leading to significant losses for those who followed the herd without understanding the underlying risks. Conversely, the myth of constant growth can lead to panic during market downturns. Investors might sell at a loss, disrupting the compounding process and locking in losses. For instance, in March 2020, the COVID-19 pandemic caused a market crash. Investors who panicked and sold their holdings missed the subsequent recovery, illustrating the importance of staying calm and maintaining a long-term perspective. Real-life success stories and cautionary tales. Warren Buffett, one of the most successful investors, emphasizes the importance of understanding compounding and investing wisely. His long-term approach, focused on value investing and holding quality stocks, showcases the potential of strategic stock market compounding. For example, Buffett's investment in Coca-Cola in the late 1980s has grown significantly through dividends and capital gains, demonstrating how disciplined long-term investing can leverage compounding. The late 1990s dot-com bubble is a cautionary tale about the dangers of overestimating stock market compounding. Many investors believed tech stocks would continue rising indefinitely, leading to overvaluation and eventual collapse. For example, investors in companies like Pets.com saw their investments plummet to zero when the bubble burst, highlighting the risks of speculative investing and the limitations of stock market compounding. Conclusion: navigating the realities of stock market compounding. As we've explored today, stock market compounding is not the simple, guaranteed path to wealth that it's often portrayed to be. While the principles of compounding apply, the realities of market volatility, sequence of returns, risk, fees, taxes, and individual circumstances make it far more complex. By understanding these nuances and adopting strategies like diversification, long-term investing, regular contributions, and cost management, you can navigate the stock market more wisely and enhance your chances of success. Thank you for joining us on this deep dive into the truth about stock market compounding. If you found this video helpful, please give it a thumbs up and share it with others who might benefit from this insight. Don't forget to subscribe for more in-depth analyses and financial tips. Stay informed, stay savvy, and take control of your financial future. Let us know in the comments. Have you been influenced by the myths of stock market compounding? What strategies do you use to navigate the complexities of investing? Thanks for watching, and see you next time.